On YouTube, welcome back to another video with the House Money Investing channel. Today's video, I got some good stock pick for you guys. About 13 Reits, 10 dividend plays, and these 3 popular stocks on Robinhood. As well as I'm gonna show you guys 3 stocks that I sold out of today. If you like this type of content, please hit the like button for me. I'd really appreciate it. Subscribe, hit that bell if you'd like to follow my journey. I do display 12 different brokerages on this channel with 100% transparency. I also analyze stocks 7 days a week, so I'm constantly giving you guys nice stock picks, stock news, price movements, and things of that nature. There's a link in the below if you want to get free 4 stocks from Webull, valued up to $3,700. Click that affiliated link. Also, one for Robinhood for the free stock, one for moomoo for a free stock, and M1 Finance for $30. So let's get into it here. So I got 3 popular Robinhood stocks that should make you richer in 2021. First, we got Nvidia. Nvidia is a massive growth stock. Believe it or not, grows about 300% per year on average. It did grow over 100% last year, even through the pandemic. It also pays a very, very small dividend of 0.12%, which isn't much, but this is more of a growth play. It's something that I personally hold long term, and it's something that I'm going to continue to swing trade. It has great analyst ratings of a 77% buy from 39 different analysts, and the firm has its first mover advantage in the autonomous driving market. You know, that could lead to widespread adoption of its Drive PX self-driving platform. The increasing complexity of its graphics processors provides a barrier to entrance for most potential rivals, as it will be difficult to match Nvidia's large R&D budget. Their artificial and deep learning phenomena that can rely on its graphics chips presents a firm with a potentially massive growth opportunity. They also have very great EPS. This is going to give you exposure to the electronic components sector of the market. And basically what they do is engage in design and manufacture of computer graphic processors, chipsets, and related media softwares. So a great play here into autonomous driving, which is very popular, and it's a booming market. Next here we have PayPal. Love PayPal. I personally use their products. I do have a line of credit with these guys. It's something I hold long term as well. I'm currently up 8.38% in my position. And PayPal grows on average about 100% a year, a little bit over 100%. They did grow up over 108% last year. They do not pay a dividend, but it is a very, very good growth stock. 45 analyst rating, 78% got it as a buy. And, there's still plenty of runway for growth in the electronic payments department. Electronic payments only surpassed cash payments on a global basis a couple years ago. The scalable nature of the business should allow PayPal to improve its margins over time. PayPal's long-running experience in online payments is a unique asset that has become more valuable as e-commerce becomes a bigger piece of the pie. Of course, PayPal has very good EPS as well, and this will give you exposure to the banking sector of the market. And basically, they engage in the development and technology platform for digital payments. They got PayPal, Braintree, Venmo, Zoom. They got all kinds of different technologies, that links customers with constant, with merchants and stuff like that. PayPal, excuse me. PayPal also just started selling cryptocurrency, which I believe is like Bitcoin, Litecoin, Bitcoin Cash, and Ethereum. I do plan on buying some crypto from PayPal, as I do own crypto and other brokerages and things of that such. So I see that as being a big revenue boost for them as well. As people are buying crypto, they're going to earn fees off that as well. So definitely PayPal are definitely dominating, that space that they're in. Next we have Pfizer, also another long-term play for me. I'm currently down 11.97% on my position, which is okay. Pfizer's kind of volatile, but I believe with the release of the vaccines and things of that such that I will make a recovery here in 2021. This thing was beaten down about 30% during the year. I think it's going to grow about 4%, 4 to 5% in 2021, and it typically does grow about 3% a year. But I think it'll grow a little bit more next year just because it's on a bounce back. They do pay a dividend as well of 4.14%, which is very good. They have a low PE ratio at the moment, so this is very undervalued. From night to analyst, you got 32% buy and a 68% hold. And Pfizer's pipeline productivity is improving with several successful recent drug launches. The stock supports a dividend yield over 3%, and I would expect steady cash flows to support that dividend. Pfizer's decisions to divest its off-patient division should result in faster growth and innovation for the company. And Pfizer's EPS has also been very, very well. And this is going to give you exposure to the pharmaceutical sector of the market. And basically they engage in the discovery, development, and manufacture of healthcare products, specializing in medicines, vaccines, and customer healthcare. So like I said, great pharmaceutical company. And they came out with the first FDA approved vaccine along with biotech. So I expect their at least first and second, maybe third quarter earnings to be very, very well. Next here I have 10 extreme dividend stocks with huge upside. So we'll jump right into these. The first ticker we have is CIM. And CIM is, it's barely over $10. This thing hasn't done very well. Just due to the pandemic, it was down like 60%. I think personally it'll grow about 9% next year. It hasn't done very well. It was doing well up until the pandemic. It was up like 80%, but it dropped. So, I think it's still going to grow about 9 to 10% next year on a recovery. They pay a great dividend of 13.71. And you got 6 analyst ratings, 16% at a buy, 66% at a hold. This is a real estate company out of New York. They also have a decent EPS, and it basically operates as an investment, real estate investment trust, and engages in investing directly or indirectly through its subsidiaries on a leveraged basis in a portfolio of mortgage assets. It includes residential mortgage loans, residential mortgage-backed securities, commercial mortgage loans, real estate related securities, and various other asset classes. So this is going to be a nice REIT for you. It's going to be a monthly payer of that great 13% dividend yield, and you're going to get some growth out of this thing next year because it's going to be on a bounce back as everything opens up and people start paying rent, the interest rates go back up and things of that such. You're going to see a growth in that sector of the market. Next we have WDR, Waddle and Reed. This one doesn't really grow that much, maybe 1% a year, if that. It had a very, very nice year last year, up 49%, but of course that was due to the circumstances. But just don't expect that type of growth every year. I would say about 1% a year. It doesn't grow very much on average. It does pay a nice solid dividend of 4%. It is still super undervalued. Low PE ratio of 17.79%. You got 7 analyst ratings, 86% hold. Waddle and Reed's captive brokerage force has tended to provide the firm with modest yet consistent inflows while maintaining an industrial low annual redemption rate of less than 10% on average for the past decade. Before 2014, Waddle and Reed had generated some of the best organic growth among the publicly traded U.S. asset managers during the previous 10-year period. By pushing its products through third-party brokerages and advisors, Waddle and Reed has become somewhat less relevant on its own sales force of registered investment advisors and provided some additional diversity to its client base. They also have great EPS, and this is an investment service company out of Kansas. and it provides investment advisory, investment management, investment product underwriting, distribution, and administration services. So great exposure to that investment services sector of the market. A nice dividend payer with a little bit of growth. So a very nice play there. Then we got BXMT. This is Blackstone Mortgage Trust. This one grows maybe a percent or two a year as well. It was down last year due to the pandemic, about 60%. I personally think it's got about 29% recovery rate for the next couple of years. So it's going to do very, very well, compared to its yearly average. I see next year as being a nice bounce back play, because this is a mortgage trust company. They pay a solid dividend of 9.3%. Their PE ratio is still pretty low, so it's still pretty undervalued. You got 9 analyst ratings at a 67% hold, 33% buy. They still had great EPS, and once again, this is another real estate company. It's really a real estate finance company which engages in originating senior loans collateralized by commercial real estate. Its investment objective is to preserve and protect shareholder capital while producing risk-adjusted returns, primarily through dividends generated from current income from its loan portfolio. So this is a nice real estate play. It's going to give you that monthly payment every month and over 9.3%. And being there, it's a bounce back play for 2021. You're going to see some nice growth out of this as well while you're collecting that dividend. So definitely a nice play. Then we got Iron Mountain, ticker IRM. Something I hold long term as well. Usually grows about 4% a year. Did pretty bad last year. It was down, about 30%. Didn't recover all the way. Still has about a 4% upside left in it, and it grows about 4% on the average. So it's pretty much almost a guarantee that's going to grow about 4% next year. They also pay a very nice dividend of 8.24% as well. And you got 8 analyst ratings at a 62.5% buy, 12.5% hold. The integration of Recall and Iron Mountain, the transformation incentive, and further maturity of certain emerging markets should drive additional revenue and expansion over the midterm. Iron Mountain operates a highly durable business model with consistent cash flows, and new opportunities in areas like data centers provide a more attractive growth runway. The firm boasts an attractive dividend yield related to other REITs. They also have very good EPS, and this is going to be a business company. They engage in the provision of storage and information management solutions. It operates through North America and some other global sectors of the world like Europe and things of that nature. So just a nice exposure, to the data information sector of the market, which is very popular as well. So definitely a nice play. And like I said, it's something that I hold long term. Next we have APAM. This one here also is a very good growth stock as well. Excuse me. Grows about 15% a year. It did very well last year, but due to some circumstances, don't expect that every year. It was up like 51% last year, but I would say on average about 25%, probably about half of that. They have a super low PE ratio, so it's very undervalued. They pay a nice dividend as well, 5.29%. You got 7 analyst ratings of a 71% buy, 29% hold. Good EPS as well. And this is another investment services company, which operates as an investment management company, which provides investment strategies to clients globally. It offers investment management services primarily to institutions and stuff like that. You know what I mean? So just basically investment management, company, another one. And that'll be something that's new for me on my watch list. Then we got NLY, Annually Capital. This thing hasn't been doing very good, but over the past 3 months it is up 14%. So they're starting to make a comeback. It was down about 50% during the pandemic. I think personally it's going to grow 7% next year in 2021, along with a nice dividend yield of 10.98%. So that's a very, very good return on your money if you get that 7% growth with that 11% dividend yield. We got 13 analyst ratings at a 77% buy. EPS was down in quarter 1 of 2020, but they made a good quarter 2, quarter 3 EPS. And this is going to be a real estate company as well, and engages in investment and financing of residential and commercial assets. They have a residential credit, commercial credit, middle market lending, things of that nature. So definitely a great real estate play, and something that I see, like I said, growing about 7% next year in 2020 with that nice dividend yield. Next year we have NYCB. This is a New York community bank. This bank was also beaten down pretty badly, about 30% during the pandemic. It hasn't done very, very well at all, generally speaking, but it's been having a nice last 3 months, up 27.92%. Now these banks most of them are going to be great bounce back plays. If they made it through that stress test back in 2020 after the pandemic, then they're pretty much set up, to keep going in business and to make a bounce back. And the banking sector is going to be huge in 2021, along with the other sectors. So, the last 3 months is kind of showing that, as they're up 27%. I probably, couldn't guess how much percent they're going to grow in 2021. It's really a gamble and a risky play. But even if it loses, I say 5%, you'll still come out winning with that 6.21% dividend yield. So that's why I would personally get into the position. And its PE ratio is only at 13.19, so it's super low. It's super undervalued. You got 16 analyst ratings, 56% hold, 44% buy. And, New York Community's superior asset quality keeps credit losses minimized, but allows managers to focus on growing the business rather than managing bad loans. The bank is one of the most efficient operators in our coverage out here in New York. Superior assets, qualify, and lean operation make it difficult for peers to compete with New York Community in the New York multifamily market. Their EPS has also been pretty good, and this is going to be a banking company out of New York, of course. And so it's a banking holding company which engages in provision of multifamily loans on a non-luxury rent-related buildings that feature below-market rents. It also offers financial products and services to individuals and businesses. So a nice banking play here. Then next up, we're going to have ticker LUMM. It's something I hold long term. I'm currently up 2.11% in my position. This one also was doing very bad during the pandemic, down about 40%. But it's had a nice last 3 months. It's been recovering. Up 15% over the last 3 months. This one also pays a nice dividend of 8.75%. This is also going to be kind of a risky play, because you might lose 10% of value next year and only receive an 8.75% dividend ratio. So you could take a loss, but the loss to gain ratio is pretty nice, because if you lose, you're risking to lose probably 1%. But if they make a comeback, then of course you're going to do very, very well. Their PE ratio is only a 9.67, so it's super undervalued. Out of 15 analyst ratings, got 33% hold, 20% buy. And the explosion in data use, particularly mobile, can make fiber assets much more lucrative than they have historically been. And their fiber holdings place it in the top 2 or 3 in the USA. Lumen should benefit from substantial synergies, considering the numerous redundant cost and tax benefits that come with the level 3 acquisition, which will boost profits and cash flow for several years. Lumen has further shifted its business away from the declining consumer and toward the enterprise, which leaves it with a better chance for future top line growth. They've also had pretty good EPS, and this is a software telecom company, based out of Louisiana. and is basically an investment holding company which engages in the provision and integration communications to residential and business customers. So definitely a nice play into the fiber optics area, and them moving away from residential to more of an enterprise space. It should give them top line growth, like I said earlier. So definitely a speculative play there, but something I'll get into and continue to add into my position. As like I said, I'm already up 2.11%. Plus I'm collecting that nice dividend yield of 8.9%. Then we got ticker WMB. This is Williams. This one here grows on average about 7% a year. It was down about 60-70% last year. I think in 2021 it should stay on par, grow about 5 to 7%. Pay a nice dividend yield of 7.11%. Great analyst ratings on this company: 80% buy, 20% hold from 26 analysts. And Williams is leveraged, to the U.S. LNG exports via agreements with LNG terminals as a key supplier of gas. After several years of structural and financial moves, Williams is positioned to maintain steady dividend growth for the foreseeable future. A large, well-positioned network allows Williams to invest in growth at high returns at a capital and minimal regulatory hurdles. Williams has great EPS, and this is an energy company based out of Oklahoma. And it operates as an energy infrastructure company which explores, produces, transports, sells, and processes natural gas and petroleum products. So definitely a nice play into that sector with the gas lines and petroleum and things of that such. And a nice steady grower with a nice steady dividend. Then I got for you guys 13 of the best REITs. We got Amt American Tower, something I hold long term. This company here is a very, very, very nice grower. Grows typically about 28% a year. They had a down year last year due to the pandemic, of course. And this is going to pay a monthly dividend of 2.06%. 20 analyst ratings got it at 70% buy, 25% hold. And data usage in the U.S. has roughly doubled every 2 years, and we expect this pace to continue to rise due to video content in the Internet of Things. In turn, carriers will need to continue investing in their networks. Wireless network development in American Towers international markets is a decade behind the U.S. and will require maximum investments as it transitions from 4G to 5G. Long-term carrier leases with built-in escalators leave American Tower with great visibility into its continued revenue growth and provide a floor for financial results. American Tower has great EPS. This is a telecom company, and it's a real estate and investment trust which owns, operates, and develops multi-tenant communications real estates. They operate in the U.S., Asia, Europe, Africa, Latin America. They have several different properties, spread all the way around. And definitely a great company. Definitely something I'm going to continue to build on and add to my position. Then we got ticker ELS. This is the Equality Lifestyle Properties. This one grows on average about 16% a year. Of course, they had a bad year last year. So next year, I think it's going to grow 10 to 16% in 2021, as it is a bounce back play. And it does pay a monthly dividend of 2.28%. You got 6 analyst ratings, 83% buy, 17% hold. Great EPS. And this is a real estate company as well, or a real estate investment trust, which engages in the ownership and operation of lifestyle-oriented properties consisting of primarily manufactured homes and recreational vehicle communities. So another great real estate play there. Then we got ticker CLOD, Americode Realty. This one here is a fairly new IPO. It started back in January of 2018. and it's been a pretty good grower. You know, they had a bad year last year, but overall, you know, it does about 19% of growth a year thus far. I think personally, you know, you're going to see it grow about at least 3 to 19% next year, as it should do very well. It's going to pay that monthly dividend as well, 2.46%. You got 8 analyst ratings, 88% buy, 13% hold. And the rise of online grocery delivery will dramatically increase demand for cold storage facilities near customers. A newfound focus on resilience over efficiency in supply chains will increase the amount of food inventory and storage, and increasing desire from customers for a greater choice and variety at a grocery store will boost demand for temperature-controlled space storage. They have great EPS as a real estate company as well, so you're gonna get that, you know, that nice monthly paying dividend of 2 to 3%. And you know, their focus is on ownership, operation, development, and acquisition of temperature-controlled warehouses. I personally deliver and pick up from these particular warehouses, and let me tell you, they're very busy and they're very packed. You know, with cold storage, and they're constantly moving, you know, freight and food through the logistics side. So definitely something I think that's going to continue to grow. You know, as this company owns these products that these storage companies are operating out of. Next, we got IIPR. This is also another long-term investment for me. This one here just started back in about 2017, early 2017, late 2016, but it has done a massive job, you know, of growing up over 100% a year. It grew 127% a year. I think it's going to stay on pace, and it's also going to pay that monthly dividend of 2.36%. 7 analyst rating, got a 71% buy, 29% hold. Very, very good EPS. And this is a real estate investment trust as well, which engages the acquisition, ownership, and management of industrial properties. You know, they got properties in Arizona, California, Colorado, Florida, Illinois, Maryland, Massachusetts, Michigan, Minnesota, Nevada, New York, North Dakota, Ohio, and Pennsylvania. And, you know, they own industrial properties, so definitely a great real estate play there. And you guys can take a deeper dive into these companies. I'm trying to breeze through them due to that I have so many. Then we got DTLR, Digital Realty Trust. This is a very good play as well. Typically up about, you know, 15% a year, with a nice dividend of 3.28%. They had a slower year last year, but they will get back on track for 2021. This one has 26 analyst ratings, 65% buy, 35% hold. And Digital Realty's global offering and high exposure to cloud providers gives it an advantage over competitors that operate in a more narrow geographic or can only offer retail collection space. The Internet of Things, artificial intelligence, and other innovations that increase the public's demand for data and connectivity require more hardware and connections in data centers. Digital Realty's shift toward connection and collation exposes it to more attractive parts of data center businesses and ride the growth tailwinds of cloud providers and data connectivity. They also have very good EPS. And this is a software company that operates as a real estate investment trust, which engages in the provision of data center and interconnection solutions. You know, they offer artificial intelligence like AI, network, cloud, digital media, mobile financing services, healthcare, and gaming. So definitely a nice digital real estate company here. Then we got ticker CUB, CubeSmart. CubeSmart, you know, it grows about 2% a year. It had a very nice year last year, but that was due to some circumstances like most other companies. Either they did really well or really bad. But this one grows about 2% a year. Pays a nice dividend of 3.82%. 3.86%. Pretty decent PE ratio at 40.44. And this one has 11 analyst ratings at a 27% buy, 55% hold. Pretty good EPS as well. And once again, this is another real estate company. And this is a self-managed and self-administrated real estate investment trust with it operates conducted solely through CubeSmart LP and its subsidiaries. It owns, operates, developments, manages, and acquires self-storage properties. So a nice self-storage play, along with public storage and things of that nature. Excuse me. So definitely a nice play for CubeSmart. Then we got ACC, American Campus Communities. This one here grows about 1 to 2% a year. It was very beaten down last year, so I think for next year it's going to grow a little bit more than usual, about 7 to 8%. A very nice dividend payer of 4.37%. Got 11 analyst ratings at a 45% buy, 45% hold. Decent EPS. Wow, I need some water. And this is a real estate company. And it engages in the development, ownership, and management of student housing communities. It has, on-campus properties and things of that such. So definitely a nice play and a guaranteed revenue growth for the monthly renters due to the, they do campus communities. So there's a lot of campuses around the United States that these college students and things of that such are going to stay in. So definitely something that's going to generate revenue, and definitely a nice play in my opinion for ACC. Then we have Store Capital. This is a long-term play for me as well. Dang it. Store Capital is very, very popular, and they grow about 7% a year. They were down last year, but it's good. It's they're gonna get back on track for 2021. Basically, is what I'm saying. In my position, I'm up 11.7%, while collecting a nice dividend payment of 4.60%. You got 14 analyst ratings split down the middle, 50% hold, 50% buy. Good EPS. And once again, another real estate company. Operates as an internally managed net lease real estate investment trust. The firm engages in acquisition, investment management, and ownership of single tenant operational real estate properties. So I'm pretty sure you've heard about Store Capital. Then we got Stag Industrials, STAG. This is another long-term play for myself. I'm currently down 5.91%, but I'm really not down as much because it does pay a dividend of 4.17%. I expect some good growth in 2021. This thing usually grows about 15% a year. It just had a bad year last year, of course, because it was down like 40%. I think it's going to recover next year, a minimum of 5 to 6%, but potentially 15 to 16%. So I'm going to build onto my position and kind of dollar cost average and lower my average cost. I'm in at about 32.52. This thing's sitting at 30.60, so definitely great upside for next year. You got 12 analyst ratings on this company at a 58% buy, 33% hold, good EPS, and this is a real estate company as well, which is a real estate investment trust, which focuses on acquisition, ownership, and operation of single-tenant industrial properties throughout the United States. Then we got Realty Income, probably my favorite REIT. This is also my whole long term. I'm down 7.25%, but it does pay a 4.78% dividend yield. This thing typically grows about 2%. It was just beat down last year, due to the pandemic. It was down about 50%. I think next year is going to be a great year for Realty Income. I think it's going to do very, very well. I think it's got an upside at about 23% growth, along with that 45% dividend yield. You got 19 analyst ratings, 58% buy, 42% hold. Realty Income provides a reliable slow growing, monthly paying dividend built on steadily performing underlying portfolio through various market conditions with reasonable leverage and ample liquidity. Realty income should have the financial flexibility to take advantage of any attractive investment opportunity that may be available. Realty income's operating history, defined underwriting criteria, and expanded portfolio transparency, which should give shareholders comfort while also maintaining management accountability. They've also had decent EPS. Once again, another real estate company, which is a real estate company which engages in generating dependable monthly cash dividends from a consistent and predictable level of cash flow from its operations. So definitely a nice real estate play. Like I said, probably my favorite REIT, in the market, and also one of the most well-known REITs. Then we got WPC, another long-term play for myself. WP carry. I'm up 2.63%. Even after the pandemic, it was down 50%. This thing usually grows about 3% a year, but I think it has a massive upside in 2021 of about 19-20% growth. So definitely a great growth play, super undervalued, a low P ratio, nice dividend of 6.2%. You got 9 analyst ratings, 33% buy, 67% hold, good EPS. Once again, this is a real estate investment trust, so another real estate company, and it operates through 2 segments: real estate ownership and investment management. The real estate ownership segment owns and invests in commercial real estate properties, and the investment management section structures and negotiates investments and debt-placed transactions for real estate investment trusts and manages portfolios of real estate investments. So WPC, a definitely nice play, something I believe in for the long term. One I skipped over here is DOC, which is a Physicians Realty Trust, which you can probably get an idea of what they do. This one grows typically about 2% a year as well. I think it's going to do better next year, growing about 2 to 6, maybe 7%. Decent PE ratio for this company. Nice dividend of 5.13%. I got 17 analyst ratings at a 53% buy, 47% hold. EPS has been jumping, but I expect to have good EPS next year in 2021. All 2020 was up, down, good, bad, based on the quarters. And this is a real estate investment trust as well, which engages in the acquisition, development, owning, and managing of healthcare properties. It offers leases to physicians, hospitals, and healthcare delivery systems. The firm's principal investments include medical office buildings, outpatient treatment facilities, acute and post-acute care hospitals, as well as other real estate integral to the healthcare provider space. So definitely a nice guaranteed play here with the healthcare sectors. Healthcare has really boomed, especially over the times we are in. And the last one's Amt, which I already went over back here in the dividend sector. Now we'll get into 3 stocks that I sold out of today. This was in my public account. If you don't know, I do swing trades in this house money account, which is deploying capital into the market, pulling that capital, leaving gains in the market. Started this challenge back in June. I've accumulated over $12,500, and I currently hold just about 1,300 stocks. So this is one here, American Homes for Rent. Sold out of it, sold for $5.11, and then I went here in the Robinhood and purchased $1 worth. I only made 11 cents on this play. I just rounded it up to $1 and went ahead and bought $1 fractional share in in Robinhood. And then we got First Energy, sold $6.37. I bought $1 of First Energy in the Robinhood portfolio. On this play, I only made a profit of 37 cents, so of course I rounded it up to $1. So on both these plays, I got my principal back. Then we got Wells Fargo, sold for $7.51. Bought $1 worth. Added actually to my position. I haven't stashed. Added another $1 worth into that position. That position is currently up 8 to 9%. So I went ahead and just added another $1 into it. As you can see here in the public account, I only profited 51 cents off this play as well. So off these 3 plays, I didn't even profit you know, but what, 99 cents. But hey, a profit is a profit, and when you got 1,300 stocks, if you can profit $1 off 1,300 stocks, you know, in 60 days, then hey, you done made yourself $1,300 in 60 days. But I'll be selling four more stocks tomorrow for the swing trade. If this type of content you guys like, hit the like button for me, please. Subscribe, hit that bell. I'll catch you guys in the next one. I appreciate you for tuning in.